All right, we are live. Welcome everyone to TradeView Live. I'm your co-host, Ben Tracy. I lead business development at Vision, joined here by my fellow host, our CEO and co-founder, Kyle.
Hey, everybody.
All right, it's been 2 weeks since we last met, and a lot has happened, although I don't think a container ship has been seized in the Strait of Hormuz, but it's seemingly everything else has happened from President Trump's visits in China to changes in fuel surcharges, and we've seen a lot going on in bookings. So welcome everyone. If any of you are new to TradeView and TradeView Live, we'll go through a few disclosures here, and then we've got some interesting trends and insights to point out. Kyle, for anyone that's new, what is TradeView? What are we here to talk about?
Yeah, TradeView is an intelligence platform built on the international freight market. We have coverage over 57% of all global ocean freight. We understand the companies moving, receiving, sending that freight, profiled 1.5 million of those companies, and turn our visibility into 90-day trade forecasts. This also allows us to map out the supplier networks. We put AI researchers into the app experience as well, serve it out via MCP servers now. But TradeView enables all of the insights that we're about to deliver to you in this presentation.
Awesome. And where does the data come from that we'll be showing in these charts?
So many different data sources, more than 270 plus data sources we've built many proprietary connections to over the past 5 years. But you could think of that as ocean carriers, booking platforms, AIS data, customs feeds, all sorts of information, terminal connections. All of this comes together. We make sense of it and turn it into these insights.
And we talk a lot about leading indicators. Later in our discussion today, we'll talk about how some of our data points will actually predate changes in rate indices or changes in trade data that's published in terms of arrivals. So how are we able to look ahead and into the future?
Yeah, some of our data sources provide booking information, and this is details about requests for bookings, the acceptance or denial of those bookings, the details of the parties, the contents, etc. And since they're bookings being requested and we see them transition into actual shipping instructions, bills of lading, and then track those shipments to their delivery, this allows us to see the plans of moving goods weeks and weeks in advance of their delivery. And to the point Ben was making about understanding rates, that means we also understand the demand side of the containerized freight industry.
So in real time, really, leading indicators, responses immediately to changes in trade agreements or disruptions, such as the conflicts in Iran and in the Red Sea. The first story that we wanted to kind of zoom in on are Brazil exports, which have gone through a lot in the last year, especially with a 50% tariff that the U.S. put on Brazilian exports. But we want to look at a different relationship, specifically Brazil's exports to India. What are we seeing here?
Yeah, you summed it up well. The new U.S. Section 232 tariff, that 50% tariff, has really pushed Brazil out of the U.S. when it comes to specifically aluminum, some other metals as well. But this is making a big hit on companies like Cargill, I believe a subsidiary of theirs, Impresa, as well. And India is one of those sources to be able, one of those locations to be able to absorb the supply that was available in Brazil that used to be going to the United States, but now it's going elsewhere. And there was a pretty major surge we saw in the past week or two in terms of these volumes, specifically around aluminum, but also many other types of products going from Brazil to India.
So, there's some things like aluminum. Brazil's got a lot of cheap aluminum to sell. It seems like there are buyers in India that have come out of the woodwork and are now buying at a higher volume than they did before. It also looks like an individual company like Cargill, I'm assuming mostly exporting agricultural products, whether they're actual agricultural commodities or fertilizer or feed. Cargill ships a lot of different things, but it seems like they've actually benefited quite a bit from the increase of exports to India.
Yeah, very much so. And we could see a little bit of the breakdown here in terms of the per week TEU, the specific aluminum products. That's a pretty sizable volume as well. But Cargill and Impresa being up 28%, there's some things to possibly be watching about those two companies.
And it's interesting. We saw a spike emerge in mid 2025 as well. I think that was around the time when those 50% tariffs were initially announced against Brazil. And it did die down. We're seeing this spike kind of reemerge here. And I think the question is, will it last, right? This was a new trend that we saw last year. It didn't happen in 2024. This trend has emerged yet again in 2026. And will it hold, right? Will these buyers continue to bring in containers from Brazil at a higher rate? Or do we see that taper off in the next few weeks? All right, bigger trade lane here, Asia to U.S. Mainly China being the largest exporter, but as no one's surprised, but we've certainly been able to highlight in our data, there are many other countries that are increasing their exports to the U.S., while China, although it represents a large volume, has actually been dropping over the last year. So what's happened in just the recent couple of weeks? What are we seeing for Asian exports to the U.S.?
Well, perhaps we're seeing a little bit of, say, an early peak season. We're usually a few weeks out from peak season, which you'll typically see in June, sometimes July, depending on what's happening in the world. But perhaps this is a touch early. Perhaps this is a bit of a response to seeing the outcomes of the Trump-Xi summit recently. While there can be, volumes of supply of different products waiting in Asia, sometimes depending on what's happening, shippers will be making decisions on when they're actually placing their bookings, et cetera, in response to geopolitical concerns. So I wouldn't be surprised if there was a certain amount of wait and see and what will come out of that summit, and then decisions are being made. But I think you can generally see there's been a slight upward trend since the tariff shock in earlier this year, as highlighted on the chart. But the volumes of this chart are Asia to the United States. It'd be interesting to bust out China specifically, but I think what we're really seeing at the heart of it is a little bit of geopolitics and a lot of slightly early peak season.
And last
With
year,
concern about transportation in general, right? Much of ocean freight has been having to get rearranged in response to the Iran crisis. So I wouldn't be surprised if there was a touch of front loading going on, just because the unknown is unknown.
Right. And last year there basically was not a peak season. We can see it on this chart, right? We had the front loading that occurred at the end of 2024 and the beginning of 2025. And then you'll see that there's really none of those higher bars. So we might be returning to a bit of a normal, maybe a bit of an early peak season. And the fact that the wait and see approach has held for so long that volumes have remained low is starting to turn the corner. Volumes are beginning to now creep upward. We saw some pretty high weeks at the end of 2025. You're seeing that just to the left of that red bar. Those were the last few weeks of 2025, really that rush before the Chinese New Year. And now, again, it's reemerging in May, potentially as an indicator of an early peak season. But the real question is this going to hold for 4 to 5 weeks? Are we going to see these high volumes that would indicate a true peak season rather than just a couple of weeks that show this level of volatility? So let's look at similar trade lane, Asia to Europe, because I think peak season has some similar behavior, although we don't quite have the tariff shock and volatility that Asia to U.S. Has shown over the last year and a half. So what are we seeing for this trade lane, Kyle?
You're seeing absorption of the supply from Asia into Europe that, some of that supply had been going to the United States previously. If we weren't just looking at Europe, you'd also be seeing increased volumes from Asia to South America to Africa as well. But at the heart of it, you're seeing a shift in the global trade balances.
Yeah, absolutely. And similar, seasonality here when we look at 2025 and the peak season, and then towards the end of 2025, seeing these high weeks. But what we're seeing in 2026 is really consistent growth. When we talk about year-on-year growth in global shipping, most of it's coming from this trade lane, the Asia to Europe trade lane specifically. Obviously, Asia to US, specifically China to US, is either flat or down year on year, while Asia to Europe is really doing the heavy lifting as far as global container shipping goes to maintain that year on year growth.
Now, Asia to Mediterranean.
Yeah, a smaller part of the Asia to Europe trade lane, but just to give kind of a really deep dive into what we've seen this year so far in comparison to last year, it does look like most of the weeks in 2026 are quite a bit higher than they were last year.
Yeah, part because of that generally increased volume that we're seeing in this relationship between Asia and Europe. Mediterranean had been a key spot to be importing Southern Europe. And there's been questions, of course, around transits for the Red Sea, which are certainly not back at the level they once were. But many of the ocean carriers have started to increase their transiting of the Red Sea, predominantly because they're calling ports on the west coast of Saudi Arabia to deal with the Hormuz crisis.
Mm.
But there's also been a shift of capacity to the Asia to Mediterranean trade, the Asia to Europe trade as well. These shifts in capacity, geopolitical politics, and the shifts in effectively demand that is going to be acted on due to tariffs, et cetera, has really set Europe and more specifically the Mediterranean at a higher growth volume than I think we would have seen had things stayed relatively the same over the past year or two.
Yeah, absolutely. So good high level. It looks like that growth in Europe is sustained and continuing, and we might actually have a bit of a rebound that's occurring in U.S. imports from Asia as well. I think what we want to do is pivot here to reflect on some conversations we've had with current customers of TradeView that specifically use this data as a early signal, a detection of a potential change in freight rates. There are lots of different things that influence freight rates, from fuel surcharges to consumer demand, obviously, availability of inventory and capacity, seasonality. You have disruptions like the Hormuz crisis. But when we look at bookings as that initial indicator of how shippers, shipping behavior is responding, typically that is, at least as far as our study goes, going to be what influences changes in the freight rates the most. And Kyle, maybe you want to summarize what we looked at and the sort of signal that we saw on these different trade lanes.
Yeah, happy to. So, as you're probably aware, we saw spot rates jump for Asia, Mediterranean, Asia, North Europe, a little bit of Asia to US West Coast. A few stories are playing out here. But what we wanted to also call out was we saw this demand and response essentially in rates playing out a week to almost 2 weeks ahead of times in terms of the booking requests, the surge, the acceleration in booking requests. There's also a play here in terms of how the capacity has been getting redeployed. So there were quite a few blanks and redeployments from Asia to the US West Coast from that trade lane, and that capacity was being shifted over to Asia Mediterranean, Asia North Europe as well. And the schedule reliability, of course, is always a question, and it's been a challenging thing this year as well. But we did see some improvements in terms of schedule reliability because of this reconfiguration in response to the Iran crisis. What this really kind of means at the end of the day is carriers are trying to manage rates with capacity. carriers are also needing to respond to the geopolitics, which, as you know, has created quite a few different surcharges. So that's also helping them better manage the rates. But that supply and demand shift also is getting played out. And then mix in potentially a slightly early peak season right now because of concerns over what might be unexpected next. And you get a situation like this. But at the heart of it, we were working with our customers and foreseeing that this rate spike was going to be coming in a pretty meaningful way about a week to 2 weeks in advance, just based upon the acceleration we saw in ocean booking requests.
And so I would say if you're one of these customers, and you're using platforms like Zenetta and Drury and NYSHEX and even ShipAngel to kind of manage your rates and your allocations by lane, I think that some of these bookings insights can be very much complementary to what those platforms offer for rate management and planning as far as controlling your costs and when should you book. When is it good to use a spot market? When is it good to use a committed contract with a carrier?
Well said, Ben.
So let's pivot a little bit because Kyle, you foreshadowed this earlier in our conversation about a deep dive into that Asia to US growth that we're seeing. Let's zoom in on China to the US. It's been a while since we talked about imports from China. Again, the talk track for the last, 14 months, ever since April 1st, Liberation Day, has been that China to US volumes have been dropping. What are we seeing so far, though, for this year and specifically in recent weeks?
Yeah, we're seeing that the relationship between China and the U.S. in terms of container volume flow, it's diminished this year. Companies have realigned their supply chains, therefore affecting the logistics, which is measurable in terms of the flow of containers. And China is just not the source of goods the way it once was. You can see here with comparison between this year, 2026, and the two previous years. At this time, we'd be expecting some pretty sizable volume spikes. And the line is, say, moving up and to the right slightly, but I think anyone could tell that it is a diminished trade relationship.
Yeah. So the comment about, hey, it's peak season is that, yes, we do see an early peak season occurring, but not really for imports from China, at least so far. It's possible that this could happen in the next 4 weeks or so. But at least for imports from China, we are well below what would be a normal peak season volume.
And again, this is bookings we're looking at.
Yeah,
So imagine these bookings are being placed anywhere from 4 to 8 weeks ahead of delivery. So
exactly.
peak season is typically spoken about in the industry by when the containers are arriving, hence this highlight of weeks 24 through 34 for arriving containers. That was the easiest way in the past to validate what was actually happening in terms of surges, in terms of declines. But since we're tapping into the actual booking information and booking data, we're able to see this far earlier. And so you can be expecting also a depressed peak season in
Mhm.
terms of China-to-U.S. container arrivals in a few weeks from now.
Absolutely. All right, let's look at U.S. imports overall. Again, we zoomed in on that imports from Asia, but what about the rest of the world? How are imports trending this year so far?
It's softer than last year, in short, because again, the tariff situation, there is a shift that played out in terms of where supply was being sent in the world, and it's not being sent to the US the way it once was. Again, this is bookings we're looking at 2025, 2026. There was a bit of a spike this time last year because of the tariff pause being announced, but this is also the time of year you'd be expecting those peak season bookings to be flowing in.
Right, right. And we did
And
see, we do see what is comparably a year-over-year increase for the last, 8 weeks, and that's specifically because in comparison to last year,
yeah,
April 1st until now was that Liberation Day post kind of everything started to drop in
this was
terms of
the deficit. This was the bounce back. This was the tapering down of that, and then kind of getting back to I wouldn't say business as usual, but what would become the new business as usual for U.S. imports.
Exactly. So what we haven't seen so far is this peak season for U.S. imports from all regions. It just in the most recent week started to trend upward, but we're nowhere near where we were in 2025. And I would assume when we look at 2024, although we don't have it on this chart, we're not near those levels either for what would typically be a normal year peak season. So that's what we've got. Some interesting stories here. The Brazil to India trade relationship, and what's really emerged for a lot of our customers in cost management, those that are really interested in the freight indices, potentially even from an investment perspective, is continued validation around the booking signal as an early detection for a change in rates.
Well, thank you all for your attendance. We appreciate it, and we'll be back in 2 weeks.
We'll see you in 2 weeks. Take care.